Hello and welcome to this week's edition of Checks and Balances TV. Today's program is entitled 4 More Years, What the President's Re-election Means to Your Future Tax Liability. So let's see how today's news may impact your financial future. As we all know, on November the 6th, Barack Obama was re-elected as the President of the United States with 332 electoral votes. Now that Mr. Obama is gearing up for 4 more years in office, many are speculating on his agenda and how the next 4 years might compare to the last. And tax increases are center stage. And most Americans are wondering what his plans are going to be for their taxes, especially with the upcoming fiscal cliff. President Obama campaigned on only raising taxes for the rich, but Republicans say his tax plan could mean higher taxes for many of us. Okay, so what's really going on here? Let's check the facts using our checks and balances process. During the campaign, President Obama ran on the promise of keeping taxes low for the middle class, while asking the wealthy or married couples making more than $250,000 per year to pay more, calling it their fair share. Specifically, Obama wants to raise the top 2 income tax rates from 33% to 36% and from 35% to 39.6%. He also wants to raise taxes on investments, including long-term capital gains from 15% to 20% and the short-term capital gains rate and qualified dividend rate, so they're taxed at the ordinary income tax rate of up to 39.6%. He also supports the expiration of the payroll tax cut, which will add an additional 2% Social Security tax to employee wages. However, these major tax changes are not just up to the president. They will be part of Obama's proposal for how to fix the fiscal cliff we find ourselves in currently. And they will have to be part of a deal with congressional Democrats and Republicans agreeing upon the whole package. In addition to these proposed changes to the tax code to address the fiscal cliff, Obama has already implemented new taxes for the wealthy that will take place next year. 2013 will mark the beginning of 2 taxes that were part of Obamacare: a 0.9% Medicare tax on earned income over $200,000 if you're single, and $250,000 if you're married and filing jointly, and an additional 3.8% tax on investment income over the same threshold. So, for example, long-term capital gains would be taxed at 23.8% and dividends taxed as high as 43.4%. During his second term, Obama hopes to push for the implementation of the Buffett rule, which would require millionaires to pay no less than 30% in taxes each year, even if their income came solely from long-term capital gains. This new rule is named after Warren Buffett, who has been a vocal proponent of raising taxes on the very wealthy. Okay, so now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. Warren Buffett has received a lot of scrutiny over his claim that millionaires should pay more taxes. But ironically, for a man who does not think the wealthy pay enough in taxes, Buffett himself has not been paying his fair share for years. His company, Berkshire Hathaway, has reportedly owed up to, believe it or not, $1 billion in taxes dating back to 2002. Most recently, NetJets, a subsidiary of Buffett's Berkshire Hathaway, is being sued by the IRS for $336 million in back taxes and penalties. But the Buffett rule may not help that much. The U.S. Congress Joint Committee on Taxation estimated that the implementation of the Buffett rule would really only raise about $47 billion over the next 10 years. And this would really only be a drop in the bucket against our nation's $16 trillion federal debt. With the national debt growing daily, it's clear that the government needs more revenue. And that means Congress needs to agree to either cut spending or raise taxes, or to do both. Obama clearly prefers the taxing method for new revenue, but Republicans argue that by taxing the wealthy more, it would create fewer jobs, and as a result, fewer people would be paying income taxes, and the tax revenue would go down. Democrats believe the opposite to be true. Higher tax rates would mean more revenue. An estimated 3/4 of small businesses are considered pass-through businesses, meaning that business income is taxed at ordinary and individual rates. Because of this, many business owners fall into the top 2 tax brackets. If Obama's tax policy is passed, these 2 brackets will see major tax hikes. And if taxes go up, we will see if these business owners can afford to continue creating jobs in 2013 and beyond. Okay, so what's the bottom line here? It's really a new era in America today. Years and years of government spending has left us with a mountain of debt. Hopefully we can begin taking the proper steps to tackle this debt now, so our children and grandchildren won't be paying for our reckless spending in the future. But it's going to take more than just raising taxes to get the federal debt and deficit under control. It's going to take real budgeting, fiscal responsibility, and making some tough decisions in order to bring down our spending. President Obama has been reelected to lead this country for another term. Let's hope his policies protect the American dream and not penalize those who want to pursue it. And now for Matt's weekly financial tip, tool, or technique. Now that the election is over, Obama has a tough road ahead of him. He needs to address the fiscal problems our country is facing, including worries about retirement programs, taxes, and the economy. By planning and preparing for what the next 4 years may hold, you can squeeze the most out of your money. So here are 3 tips to help you. Number 1, treat Social Security as a supplement, not a replacement. To help Social Security become more solvent, the President supports the payroll tax increase, which would increase employees' Social Security tax from 4.2% to 6.2%. However, there's a lot more work that needs to be done to fix this important program. But you can avoid worrying about Social Security by building your own financial nest egg using a traditional or Roth IRA or using annuities. Tip number 2 is rearrange your investments to avoid the dividend tax. One of Obama's major campaign messages was to ask the wealthy to pay more taxes. Obama supports taxing qualified dividends as ordinary income tax and increasing the top rate from 15% all the way up to 39.6%. And this could really hurt retirees who live off their dividends. So try lowering your tax rate by lowering your countable income through tax-deferred investments such as annuities, and forego investing in dividend-paying investments if at all possible. And number 3 is grow your investments at least at the rate of inflation. The President plans to keep interest rates very low through at least 2015 to encourage lending. But this can also mean very low returns on savings dollars. So try to grow your savings faster than the average rate of inflation, which has been traditionally 3% a year. Consider Treasury inflation-protected securities, also known as TIPS, that increase with inflation, or using other alternatives rather than keeping most of your money in the bank. Most importantly, stay informed. With frequent changes to public policy, be sure you're staying current on what's happening on Capitol Hill with your money. And also, be sure to work with a true financial advisor. Be sure to log on to our website and download our featured report, The Truth About Taxes. A free report that gives you the information you need to legally reduce or eliminate some of your annual tax liabilities. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Until next time, dump debt, invest wisely, believe in yourself, and make it happen.